Okay, sir. Thank you, sir, for giving me opportunity. Good afternoon, everyone. I am Rohan Tukaram Pawar. My topic name is risk analysis and forecasting in investment and portfolio using Excel and AI. Agenda of my presentation is introduction to topic, investment portfolio basics, risk analysis in portfolio, forecasting methods in finance, role of Excel in risk and forecasting, application of AI in finance, building Excel based on financial model, case study and practical examples. Objective of my project is to understand investments. What happened? Objective of my project is understanding key investment concept, learning how to analyze risks in portfolios, explore forecasting method using Excel tools and AI model to manage portfolio, apply learning through a case study and dashboard. Hello. Introduction. Investment portfolio definition. An investment portfolio is a strategy of financial assets such as stocks, bonds, mutual fund, gold, and other securities held by an individual company or institution. The purpose is to build wealth, generation return, or meet further financial goals while managing risks according to investment profile. Key concept: the portfolio acts like a basket that holds a varieties of investment, balance, growth, and safety based on investor needs. Key points: the portfolio is and spreading out investments. The spreading out investment risk. A portfolio avoid putting all money into a single asset. For example, just putting all money into stocks. If one asset underperform, example, stock market crash, others like gold or bonds can protect other overall value. Diversification helps to unsystematic risks tied a particular company or sector. Example of investment portfolio: if your equity investments drop by 10% due to market volatility, again in gold or bonds might offset some of the losses. Risk definition. Risk analysis is the process of identifying, assuming, and managing uncertainty that will affect the value of investment portfolio. Importance: every investment carries some of level of risk. Help investor to understand possible losses. Guidance better investment decision. There are four types of risks. Market risk. Market risk happen due to market volatility or a market crash. Credit risk, default by borrower. Liquidity risk, inability to sell investment quickly in any situation. Operational risk, due to an internal failure or fraud of any. It is known as operational risk. Forecasting in finance. Forecasting in finance. Forecasting in finance means predicting further financial outcome like return, price, and risks based on historical data and example. Important: helps plan for further investment, reduces supports usually for corporate finance terms and individual investor. Assets in setting exemption or return, budgeting investment amount and comparing scenario. Method in finance: the first one is time series model. Example, AIRM. AIRM means auto recognizing integrated movie predicts further value based on patterns in historical data. Second one is moving average. Short-term faulty or reveal underlying trends. Simply, sim, simply moving average. Average of last n data points. Exponential moving average gives more weightage to recent data. Example, using a 10 days moving average to determine if a stock is trending upward. Third one is analyzing, identifying relationship between variable. Linear recognize can predict a depend variable. Example, stock return based on indexed variable. Example, interest rate, GDP. Outcome include slope, interpret, and R2 value, fit of model. used in Excel via data analyzing and recognizing tool. Machine learning model is known as ML. ML use an alternative to learn for historical and predictive further outcome. Common model, linear recognition, decision trees, random forest, STM means deep learning for time series, especially powerful for larger data set and nonlinear patterns. Need to prove training and data validate into avoid forecasting. Tool used for forecasting in finance, tools are used. Excel for forecasting sheet, quick projection with and trend line and confidence interval. Trend line in chart added recognition or explosion line to short growth. Second one is AI and machine learning tool. Python, libraries, pandas, and sustainability model. Second side, risk and forecasting are important in portfolio management. Uh, Reason, the minimizing potential losses. Risk analysis helps identifying possible intensive outcome before they happen. It enables prevention strategies like portfolio diversification, stop losses, orders, or heading with an diversity. Example, if a stock market showing sign of velocity, investor can limitly export. Second one, minimize the potential return. Forecasting model predicts favorable investment opportunities and trends by identifying assets like to perform well, investor can shift allocation toward the higher performance sectors. Example, forecasting the sector outperformance and rebalance portfolio to include top IT funds. Third one, make data diver decision. Decision backed by a quantitative data and model, reduce emotional biases and gives work. Unable to objective and evaluating using historical trends, statistical analyzing, and AI, improving continuity and transparency in decision making. Fourth one is preparing for uncertain market condition. Risk analysis and forecasting helps sustainability, various economics scenarios, inflation, fixed interest rates changes, and etc. Tools like stress testing, scenario analyzing, preparing investor to handle downward or velocity. Example, in COVID-19, market crash in 25 points to 35 points, where successfully when portfolio had risk buffer. Next, traditional method versus modern method. Traditional method use manual calculation, use of basic statistical formula limited by human capacity, time consuming and prone to errors. And modern tools, Excel, AI, automated and fasted calculation used for larger data set, machine learning to dedicating more accuracy and efficiency. First, modern learning and smart analyzing. Investment professional previously relied on pen and paper for manual spreadsheets and tasks like compounding returns were performed by step. Sustainability to human fraction and calculation mistake. Example, calculating average return across 660 months manually increase changes of errors and consumer time. Use of basic statistical formula. Only basic formula like average, variances, percentage changes everywhere used. No one use advanced statistical or predictive technology like recognizing, monitor, simulating, or machine learning, limited by human capacity. And analytical can only handle a limited number of data points. Forecasting were based on intention, small data sets, and basic tools. Example, analyzing 10 companies data manually is possible, but 1,000 companies not practically without automation. time consuming and prone to errors. Collecting, process, and analyzing data manually takes significant time. Repeating the same calculation across different time period or variable increase fraction based on modern tools, Excel and AI, automated and fast calculation. Excel automated repeat tasks using functions, formula, micros, and solvers. AI system can process millions of records within a second, but in traditional, they will take 1 to 2 years to record millions of record. In automated and fast calculation, time is saved more for strategy thinking and client interaction. Uses of larger data set. Excel with power queries and pivot table can handle thousands of rows for financial model. AI tool like Python and R handle big data pulled from APS market, feed an online data set, enable real-time analysis or dynamic data sources like Yahoo, Finance, and Bloomberg. Machine learning for pattern dedication. Machine learning model can uncover hidden patterns, trends, and collaboration. Example, random forecasting for portfolio, classification, LST for long-term service, and predictive for new sentiments analytics. Dedicate trends before they are obeying for to human analytical, more accurate and efficient. uh, Reduce and base and human errors, dashboards and scenario simulative to allow faster and visual interactive decision making, better risk management and more precious. Here is a comparison between traditional and modern. In traditional speed, in traditional there is a small speed for working. In modern there is fast speed because we are using in uh, Excel and AI. Accuracy in traditional there is medium. In modern there is high accuracy. Data capacity in traditional we can collect limited data. In modern we can collect more data in larger scale. Learning ability in traditional none. In AI and Excel, AI can learn more. Role of technique. Next slide. Tools overview. Excel AI model. Excel used for financial modeling, dashboard, forecasting scenario, analyzing functions, forecasting sheet, Solver, and data table chart. AI model, machine learning, ML, for written forecasting, natural language processing, NLP, for analyzing news and sentiments. This is used to detect the news and what will happen in based on news in market. Deep learning, LST model, long short-term model used to time surveys and prediction. Understanding investment portfolio. Next topic, components of portfolio. A portfolio made up of max of investment. These include stocks, bonds, mutual fund, EFTs, gold, real estate, cash or fixed deposit. Investment portfolio is a collection of financial and physical assets held by an individual or institution to achieve specific financial goal. A well-contract portfolio combines multiple asset classes, each offering different level of risk, return, and liquidity to balance growth with sustainability. Stock ownership is an company. Stock, stock means stock represent ownership owner shareholder of that company. Returns come from capital appreciation, dividend, risk level, return potential. Example, investing in TCS, Infosys, and Reliance. Bonds. Bonds are loans made by investors to government. Multiplating of companies. You can earn interest on lending your money. On maturity, the principal is an rapid. Types of bonds: government bonds, corporate bond, tax-free bonds. Risk level in the bonds, there is a risk level low to medium, depend on issuer. Return potential, moderate and substantial. Example is by corporate government of India bonds. Use in portfolio provides income, sustainability, and consuming against the stock market volatility. Mutual fund. Mutual fund pulls money from multiple investors to invest in diversified portfolio of stocks, bonds, and other assets professionally managed by fund house. Example, SDFC Mutual Fund, ICI Mutual Fund, Blue Chip Mutual Fund. Ability in equity to debt, header, and index category. Risk level depends on fund types. Equity is equal to higher risk. Debt is equal to lower risk. Return potential, variances by and strategy and market performance. Use in portfolio of diversification, access of and professional management. EFS like mutual fund trade like a EFS stands for exchange fund. EFS is similar to mutual fund but are trades on stock exchange like share. Tracks index like Nifty 50 or sector liking banking, IT, low cost transfers and real time pricing. Risk level depends on underlying asset. Return potential match benchmark performance. Gold or real estate, it is an physical or alternative assets. Acts as an hedging against the inflation currency policy. Available as physical gold, digital gold, gold bonds, or gold efficiency. Risk level is low to medium. Return policy moderate act protection. Real estate investment in potential requires higher risk capital and is less liquidity. In the gold and real estate, risk is medium. Cash or fee, cash refers to money, help in saving account or invest in bank deposit FD. Highly liquid and safe. Return policy low. Generally 3% to 7% annually. Offer gratuity under the law in period of 5 years. Risk level, emergency fund, short-term goal coverage, and protection against volatility. Portfolio example: stock allocation of 40%, purpose long-term growth. Bonds allocation of 25%, stayed in income. Mutual fund allocation of 15%, diversified exposure. Gold allocation of 10% against the market crash. Cash and FD 10%, emergency and liquidity buffer. Next slide. Types of investment. Uh, Types of investment: equity, debt, real estate, commodity, cash liquidity, and cryptocurrency. Equity, high risk and high returns. Debt, low risk, stable in income. Real estate, long-term appreciation. Commodity, inflation hedges. Cash annihilation, very low risk. Summary of table: asset equity, risk high, return potential high, liquidity high. Example, Infosys, Reliances. Asset classes: debt, bonds, FDs. Risk level is low to medium. Return potential moderate. Liquidity high to medium to high. Example, government bond, FD. Real estate, risk level is medium to high. Return potential moderate to high. Liquidity low to. Example, flat RFTs. Commodity risk level is medium. Return policy is moderate. Liquidity is medium. Example, gold, oil. Cash equality, risk level is very high. Return policy low. Liquidity very high. Example, T-bills, savings. Cryptocurrencies, risk level very high. Return policy is very high. Liquidity high. An example, Bitcoin. Risk return trade-off. Investment as are capital. Last slide we had a portfolio diversification. How can we build diversification portfolio? In some case, we get in loss. Diversification and management strategy involves investment in a varieties of financial instruments, assets, class, industries, and geography to reduce the overall impact of poor performance from any single investment. Simple and do not pull eggs into one basket. Basket foods. You may break all the exits, but if you divide them into a multiple basket, a loss is one does not runs everything. Diversification. When you diversify your investment, you limited exposure to any single assets or risk sources. Protect your all portfolio during downward in a specific sector or asset class. Extend sustainability by combining assets that react difficult to the same market events. Offer smoother over investment in different asset class sectors and geographic. It reduce impact of loss in any one area. If stock performs babily gold or bonds in same portfolio, maybe sustainability will perform. Allocation. Asset allocation means deciding how much investment in each asset class based on your goal, age, and risk tolerance. Risk tolerance. Example: you are younger investor in your asset. There will be 70% of stock, 20% bond, and 10% cash. You are retired investor. There should be 30% stock, 50% bond, and 25% cash. Let's say, for example, let's say you 10 lakh portfolios allocated by following assets. Risk tolerance and investment portfolio. Risk tolerance, how much loss an investor can emotionally and financially handle. Investor portfolio. Conservation, low risk, performance, stability, income, moderate balance between safety and growth. Average, high risk, high return. Diversify across asset class, combine stocks, bonds, real estates, and cash. Example, either equipment due to market volatility, bonds or gold may be hold to increase across sector, spread investor among the technological, healthcare, FNC banking, infrastructure. Example, a slowdown in IT might not affect or ability across geographic investment in both domestic and international market. Example, India, US, emerging market. Example, in India, economic slows down, US equality or global efficient may be often the impact. Wait a minute. Short term and long term. Short term investment held for less than 3 years. Example of T, treasury bills, liquid, mutual funds, gold, capital, protection, quick return. Investment held for 5+ years. Example, stocks, real estate, retirement fund, and gold, wealth creation, beating in inflation. Features of a long term and short term. Time horizon, less than 3 years. And long term, 5 or more years. Main goal, capital protection and return. Wealth creation and beating fight. Risk level, generally lower risk. May involve higher risk but better return. Returns sustainable, usually lower. In long term, higher potential return over a time. Liquidity, high liquidity, easy to sell. Long term, less liquidity. Example, real estate, long term, buildings, land. Example of short term investment, funds, treasury bills, liquidity, mutual fund. Long-term investment, stocks, real estate, retirement fund. Investor type, short-term planner, long-term with wealth builder. Tax impact in India, lower tax benefit on the term of gain, low long-term tax, long-term capital gain tax in usually lower. Example, portfolio of Mr. X. Here age is 30% and he has 50% stocks in equity mutual fund, 25% bonds, debt fund PPF, 15% gold, digital gold, 10% cash, saving accounts and FDs. Portfolio optimizing. Portfolio optimizing means creating a best combination of assets from highest possible return with lowest possible risk. Method use main variances optimization, Sharpe ratio maximization using Excel solver or Excel based. Portfolio optimization is the process of choosing best possible combination of assets. Example, stocks, bonds, mutual funds, gold to achieve the highest possibility expected return with the lowest possible level of risk. This is analyzing past performance risks and collaboration between the asset to find most efficient mix. Objective of portfolio maximization. Goal, maximize return. Choose assets that offer high return for given risks. Minimize risk. Choose a mix that sustainability the portfolio during market swing. Achieve efficient allocation. Invest in asset that works well together. Lower correlation. Manage risk. Your portfolio fits the investor risk tolerance and goal. Methods include mean variances optimization, developed by the Hiren Mork2 modern portfolio theory. This model seeks to build a portfolio that offers maximizing return or give a level of risk or minimize the risk from a given return. It uses expected return of each assets, velocity, standard deviation, covariance, correlation between asset in the efficient for the curve or optimizing portfolio. Assets are chosen not just based on return, but how they interact with other assets in portfolio. Sharp ratio maximization. Sharp ratio measures the risk adjust return of an investment. The portfolio optimizing using sharp terms and maximizing return using Excel solver or AI based model. Excel solver is an built-in tool that can use to maximize or minimize a formula like expected return or risk, adjust weightage of a different assets applicable to contract. Example, no asset gets more than 40% allocation. Steps of an using Excel solver or AI-based model. Input historical return of four assets. Calculator profile, portfolio, return, and standard deviation. Set and solver to minimize the return or Sharp ratio. Apply contract like weightage add up to 100%, minimize or maximize weightage limited. Run solver. It inputs the optimal weightage allocation. Importance of portfolio rebalancing. AI-based portfolio optimizing with an interest rate. I want to give example of the portfolio optimizing investor goal. Maximize return while keeping risks below 12%. Asset consider Nifty 50, gold, corporate bonds, fund, international mutual fund. Excel solver outcome solver suggests 40% Nifty 50, 20% gold, 25% bond, and 15% international fund. Return is equal to 13.12%, risks 11.9%, Sharp ratio 1.1. Portfolio optimizing for return while keeping risk with an acceptable limitation. Minimum variances used for building efficient for 10. Tool used for minimum variance optimization is Excel, Python. Sharp ratio maximization used for risk adjusting performance comparison. Tools Excel solver, Python. Excel solver, manual optimizing with an contract, constellating an Excel. Optimizing best balance between risk and return. It's mathematical or not emotional. Is and greater for beginner. AI is and powerful for complex portfolio. Example, max risk or sector limited makes a real world modeling practical. Importance of portfolio rebalancing. Rebalancing is an adjusting portfolio back to your original example example if your 60% stock grows to 70%, you will sell some stocks and buy bonds to maintain a balance. Importance: keep risk under control, lock in profit, maintain discipline in investment, do not invest more money in one asset. Market indicators impact for portfolio. First, I am going to tell you what is market indicator. Market indicator are quantitative and qualitative tool used by investor analyzing an economic to evaluate the current and future condition of financial market. Financial, sorry, to evaluate the current and further condition of financial market. This indicator affects how different assets in portfolio performs by inflation, investor behavior, market cinematic, interest rate, and microeconomic trend. These microeconomic indicators influence the performance of an financial asset such as stocks, bonds, mutual funds, and gold. Understanding their impact help in investor and portfolio management. Indicators that affect the portfolio. First is stock market index. Example, Nifty 50, Sensex. Stock market index represent the performance of a group of major listed company. Example, in Nifty 50, there are 50 top company, and in Sensex, there are 30 market capitalization. Nifty 50 tracks 50 larger cap companies across the sectors of National Stock Exchange, which is means by NSE, and Sensex tracks 30 prohibited companies listed by BSC, Bombay Stock Exchange. Impact of portfolio in stock market: a rising index, strong coordination, performance, economic optimization, portfolio gain, a falling index, market uncertainty, investor fear, decline in inequity. For example, of stock market in Nifty 50 rise by 10%, your mutual fund holding Nifty 50 based stock will likely increase in value. In conversely, a crash in index can reduce portfolio returns significantly. Interest rate, RBI policy rate. Interest rates such as repo rate are a set of Reserve Bank of India (RBI) and determine the borrowing cost from banks and business. Higher interest rate, money becomes an expensive, borrowing drops. Lower interest rate, cheap borrowing, economic activity increase. Impact on portfolio: interest rate. When price falls, and equity valuation may be decreases due to higher discount rate. When rate falls, stock often rises due to cheaper capital and bond. Example of interest rate: if RBI increases repo rate from 6% to 6.5%, 5%, your longer term debt mutual fund may drop in value while bank stock might benefit. Inflation rate, consumer price index CPI. Inflation is a rate at which the price of goods and services rises. CPI is the most common measure inflation in India. Moderate inflation indicates economic growth. High inflation reduces purchasing power and can hurt savings. Impact on portfolio: high inflation hurts fixed income and FD bonds as real returns often act as a headed and may be rising during inflation. Stocks may suffer in inflation leads to cost pressure on company. Example, inflation rises to 8% and your FD gives 6% interest, your real return is a negative. I an example, inflation rate rises by 8% and your FD rate gives you 6%. Your hello, someone have a question? Your real return is a negative by -2. There's a difference of 2 because RBI is giving 8%, your FD is giving 6. GDP growth rate. Hello, someone have any query? GDP growth rate, unemployment rate. GDP, GDP, gross domestic product. GDP measures the total value of goods and services products in a country over time. It indicates overall economic health. High growth domestic product indicates expand economic job creation and business profit. Low or negative GDP growth signal contract recognizing high growth boosts equity markets as company gains better earning. Sector like banking, infrastructure, and manufacturer performs well. Weak GDP growth leads to a risk of behavior shift to bonds, golds, or cash. Example of GDP. In India, GDP grows at 8%. Stock market expand to rise, benefiting equity, mutual fund, and direct stocks. Unemployment rate. Unemployment rate shows that percentage of people in the labor force who are actively seeking but not finding job. Low employment rate, consumer spending increase, business profit rises. High employment rate, lower spending, weak earning, market weaks. Falling unemployment rate supports equity, especially retail, auto, and FNG sector. Rising employment rate indicates economic. Example, during COVID-19 in lockdown, India's unemployment rate spiked to lead a sharp fall in market. Because of COVID-19, many of the companies have fired their people from their company. That's why unemployment rate was high. Indicator impact on portfolio. Indicator stock market index rising portfolio gain. Negative impact when falling index equities. Interest rate falls, stock and bonds rises. In interest rate positive, the stock and bonds are rising. In negative rate, bonds and prices falls. Inflation, low moderate inflation, sustainability, high inflation return. GDP growth, high growth, strong equities, low growth investor quotation. Unemployment, long strong demand, high weak market. Economic factor affecting portfolio. A factor including inflation, interest rate, exchange, and government policies, and global inflation reduce value of money. Interest rate affects bond price and borrowing. Exchange rate impacts international investment which is done by foreigners in our Indian. Government policies, taxes, tax laws, global events, war, pandemic, trade-off relation. Role of interest rate in inflation. Interest higher rate is equal to bond prices, lower stock ability. Lower rate encourage borrowing and investment. Inflation reduce purchase power. Investor must earn return above the inflation to growth wealth. My next chapter is risk in investments and portfolio. Risks, financial risks. Risk in investment and portfolio. Financial risk. Financial risk refers to a potential of losing money or not achieving expected return on an investment due to various international or external factors. It integrates in all types of investment, whether in stocks, bonds, fundamentals, real estate, or even saving interest. The in I am going in simple language that the changes that your investment will not be give you return you hope you for you, or may even causes a loss. Example, if you buy a stock and purchase it at falling price, that is a financial risk. There are four types of risk. Sorry, one thing remain. Key characteristics of financial market. Uncertainty of outcome. You may earn more or less or loss from your investment, affecting all asset classes. Stock, bonds, mutual fund, goals, real estate, and even fixed deposit can be measured using and statistical tools like standard deviation, beta, value at risk, VRA, can be managed, but essentially common causes of financial risk: market volatility, sudden ups and downs, reduced asset valuation, company failure, poor result of bank corrupt can wipe out stock value, inflation, reduce the value of return, interest rate changes, affects bonds, price, and stock valuation, potential economics events, election, wars, or policy changes can rise the uncertainty, currency inflation, in fact, international investments and returns, liquidity crisis, unable to sell assets without loss. Next topic is types of risks. There are four types of risks. First one is market risks, credit risks, liquidity risks, and operational risk. First risk is market risk. Market risk is a loss due to fluctuation, due to changes in market price, stocks crash, interest rate changes. Market risk is also called as systematic risk because it affects the either market and cannot be insulated through causes of market risk, stock market crash, interest rate, potential instability, global crisis, example wars. Nowadays there are wars, that's why market is going down. Example, in March 2020, COVID-19 pandemic, the Nifty 50 falls over 30% in a few weeks. Suppose an investor had a 5 lakhs in equity mutual fund. After the crash, the value drops to 3.5 lakhs, loss of 1.5 lakhs. This is a market risk as the value falls due to external market wide events beyond the investor control. Second one is credit risk. Borrower may not repay loans. Example, company default on bonds. Credit risk is also called as default risk. It's mainly associated with debit instruments like bonds, debenture, and fixed income products. Causes of and credit risk: poor financial health of issuer, bank corrupt or fraud in bank, economic slowdown. In example of the credit risk, you invest 1 lakh in an corporate bond issued by a company, BAC, ABC, promising 8% annually interest. After 1 year, company ABC faces bankrupt and is unable to pay interest or return principal. The either investment is at risk. Credit risk has materialized. Example, LIS and FAS defaults in 2018 lead to massive losses in debt mutual fund. Third one is liquidity risk. Cannot sell your asset quickly without a loss. You invest 10 lakh in an commercial property. Suddenly you need cash for a medical emergency. You cannot sell the property fast, or you were forced to sell at 30% lower price to attract a buyer. The liquidity rises. You have two asset but could not that is that is happen because assets are not actively trade off, no ready buyer in market, tight market condition. This is known as a liquidity asset. Operational risk: internal errors, frauds, or systematic failure in an company. This type of risk is often non-financial in nature and comes from inside the business rather than the market. Operational risk. Uh, the causes of the operational risk is cyber attacks, data entry errors, fraud, technical failure. Example of in 2019, Yes Bank internally audit system failed to catch risky lending practices. Faulty loans were issued. Banks suffered massive losses. Investor in Yes Bank shares and bonds lost money. A classified operation that affects shareholders and bondholders. In simple language, here is a table. Here I explain in simple types of risk definition and example. Market first risk is market risk definition: loss due to market wide events. Example, stock market crashes. Second one is credit risk: borrow definition, borrow fails to repay loans or bonds. Example, company default on. Third one is liquidity risk definition: cannot sell asset quickly at a failure value. Example, try to sell a low volume stock. Risk type is operational risk definition: internal issue like fraud, errors, or systematic failure. Example, stock market. Example, software crash in bank. This is the types of risk. First one is market risk, credit risk, liquidity risk, and operational risk. Next slide is systematic risk and systematic risk versus systematic risk. Systematic risk is a market risk affecting the other market. Risk is an intercreated risk that affects the either market or a large segments of the company and economy. It is a non-diversified. No matter how much you diversify your portfolio, you cannot avoid this type of risk. The causes of the systematic risk is changes in interest rate, inflation, economic recognition or bombs, global events like wars, pandemics, natural disasters like flood, earthquake, government policy and regulation changes. I am the example of the systematic risk. During the COVID-19 pandemic in March 2020, the stock market across the global crashed by 25 to 35%. Even well diversified portfolio lost value as the other market has affected. This was a systematic event. The characteristics of the systematic event is affect all the assets, stocks, bonds, real estates, can be measured using the beta, cannot be essentially only managed. Second one is an unsystematic risk, which is specific risk, affect single company or sector. Systematic can affect all assets like bonds, real estates, and unsystematic risk specifically, it can be affect only for one single company. Unsystematic risk is a company or industry specific risk that can be reduced or eliminated through diversification. It rises for internal factors within a company or sector, causes poor management decision. Unsystematic risk causes by poor management decision in company, product failure or recalls, labor strike or lawsuits, company frauds, industry downwards. These are the causes of the unsystematic risk. Example of unsystematic risk. You invest 1 lakh in Jet Airways stock in 2018. In 2019, airline shut down due to debt and mismanagement. You lost 90% of your investment. This is an systematic risk or specific company. Unsystematic risk means which is happened by a specific company in specific company by a poor management decision, product failure or recall, labor on strike, company fraud, or etc. industry downturns. Characteristics of unsystematic risk only affects one company or sector. In unsystematic risk that only affects one company or sector can be eliminated by diversification measure using standard deviation of stocks. Next slide. I have explained in this in short. Systematic affects either market or economy. In unsystematic affects specific company and industry. Diversification in systematic cannot be reduced. In unsystematic can be reduced. Example of unsystematic risk: inflation, war, interest rate hike, company frauds, bad management, control. Systematic risks out of investor control. Unsystematic risk can be controlled by analyzing features, company, no market risks, non-diversified risks, specific risks, diversified risks. Next. When risk is happen, how can we measure the risk? First, risk is measured using statistical and mathematical tools that tells us how unpredictable or velocity in an investment. Common measuring tools of the risks are standard deviation, variances, beta, value at risk, VRE, Sharp ratio, seniority testing, and trace testing. Standard deviation and variances. First, standard deviation, how investment returns deviation from average returns. Measure to velocity or voracity to invest returns. A higher standard deviation is equal to higher risk is equal to returns variance widely average. A lower standard deviation is equal to more sustainability. For example, funds A has average return of 10% with standard deviation 3%. Fund B has same return of 10%, but standard deviation of 8%. Fund A is less risky because its influence the less. Means which standard deviation is less, that one is less risky, and in which standard deviation is high, that's which more risky. High standard deviation is equal to more velocity is equal to higher risk variances. Square of standard deviation also shows spread of return. Measure to spread of return around the means, it's the square of standard deviation. Standard deviation variances means high variances is equal to return are more unpredictable, used mainly in advanced portfolio optimizing model. Example of variances are a stock with return ranging from -10% to +20% will have an higher variances. Then no one can fluctuate between 8 to 12. Next one is beta confit. Measuring a stock from beta sensitivity to market movements. Example Nifty 50 and Sensex. Beta tells us how a stock reacts compared to a market. Beta is equal to 1. Stocks moves externally with markets. Beta is greater than 1. Beta is greater than stock is more violent than the market. Beta is less than 1. Less volatility. Stock is less volatility than the market. Here I have given one picture. Beta is equal to 2. Twice volatility as Nifty. Beta 1 is equal to volatility as a Nifty. Beta is equal to 0. No correlation with Nifty. When the beta is negative, it is mean the portfolio is performing. Example of the beta, a stock, suppose the stock X has beta is equal to beta 1.5. If Nifty rises by 10%, stocks X maybe rises by 15%. Stock Y has beta 0.7, more stable, less responsive, or market swing is known as beta. Value at risk, VRA, estimated the maximizing potential loss of an investment over a specific time at a given confidence level. What is mean? Helps understanding worst case scenario commonly used in institutional risk management. Warrants estimate the maximizing the loss an investment might face over a given time with a certain confidence level. Example helps. Example, there is a 95% chance that want to lose more than 10,000 in a month. Common timing frame is 1 day to 10 day or more than. Method, historical parametric and Monte. Portfolio value is 10 lakh. Next one is Sharpe ratio and correlating ratio. Sharpe ratio. Sharpe ratio measures the risk adjustment ratio of an investment. High Sharpe ratio is equal to better return per unit of risk. Compare performance across portfolio or fund. Formula of Sharpe ratio is equal to return minus risk-free rate into standard deviation. Standard deviation. For example, fund A is a return is equal to 12%. Beta is equal to 6%. Risk-free rate is equal to 5%. And Sharpe is equal to 12 minus 56. Sharpe. Fund B returns 15%, beta 12%, and Sharpe 0.83. Even thus, the fund B has higher return. Fund A is better risk adjustment. Certain ratio like Sharpe but only consider downside risk used to compare performance of fund and portfolio. Here are the drawing. Stress, stress testing in investment risk. Stress testing in risk management. Stress testing. Testing. Testing a portfolio under the extreme put and evaluating worst case outcome. It means simulating crisis like 2008 recognize COVID-19 crash or war tells us whether the portfolio can survive the shocks. Stress testing shows how your portfolio would behave extreme conduct like market crash, COVID, like pandemic, sudden interest rate hikes helps to prepare your worst case scenario. Example, a portfolio is 70%. Portfolio is 70%, equity is 20%, debt is 10%, goal. And this in simulated crisis, equity for 30%, debt for 10%, gold rises, gold rises 15%, net portfolio equal to 7, helps in risk controlling and strategy allocation. Next one, risk matrix example. Risk matrix shows the level. Risk matrix shows the level of risk by comparing probability of event happening, impact if the event happen, high chances, medium and low, low impact, high chances, low impact, moderate, medium impact, high impact, critical, in medium, low impact, low, medium impact, moderate, in high impact, high, in low impact, low, medium impact, low, and high impact, moderate. Tools to track risk in Excel, pivot table, data table, solver, forecasting sheet. Pivot table summarize the risk across the sector. Data table analyze how changing one factor affects the portfolio. Solver optimize the least risk. Forecast sheets predict further returns. Graphical risk presentation. Visual risk using line chart shows on velocity, histogram, returns, distribution, pie chart, risky by asset class, scatter plots, risk versus return. Next one is heat map in Excel. First, I am going to tell what is heat map. Heat map is an visual tool that used to color coding to represent the incent or severity of risks across the different areas of an portfolio or organization. It helps stakeholders quickly to identify which asset sector or scenario carries the most risk and where they should focus their attention. Instead of number, you get color, so even a non-expert can understand where the danger lies. Color indicates Red color indicates high risk, impact action or review required. Yellow, medium, means monitoring the control and moderate attention needed. Green, low risk, stable and non-intimidating action needs. Here are Here in yellow, there is a low risk, medium risk. In red, there is a high risk, and in green, there is a low risk. This how the heat map works in Excel and how we can track. Next topic is forecasting in investment portfolio. Forecasting in investment in Forecasting in finance. Forecasting refers a process of using historical data, market trends, and stable statistical model to prevent further financial outcomes such as price, stocks, price at rate level. It helps investor to anticipate market movement and makes inform productive decision rather waiting to change after they happen. In simple language, forecasting turns data into insights. It tells us what might happen so we can prepare before it does. Forecasting in finance means predicting. It helps to investor to make better decision by estimating what might be happen in and forecasting. Importance of forecasting. Importance of forecasting. He helps in portfolio planning, guide in buying and selling decision, avoid unnecessary risks, asset in budgeting and goal setting, example prediction, next quarter, stock pricing using historical trends. First one is help in planning. Forecasting allows investor to estimate the returns, risks, and market behavior. It support decision like how much to invest in each asset class, when to increase or reduce equity exposure, how to rebalance based on project growth. Example of help in portfolio planning. If a forecast shows equity market will be volatility next year, an investor may shift 10% of their portfolio from equity to gold or to reduce overall risk. Is known as help in portfolio forecast guidance in buying and selling decision. Forecasting model helps to determine when to enter or exit a position, a price, trend, indicator, or moving average can single buying and selling point, prevents emotional or panic based on decision. Example of forecasting return. A moving average forecasting shows a breakdown in an IT stocks. The invest by early and benefits from the upward trend. Avoid unnecessary risks in forecasting. Highlight potential downturns or bundles in sectors or assets. Helps to investor to take defensive action before a loss occurs. Ensuring risk adjustment investment instead of chasing high returns blindly. Example of avoid unnecessary risks. Forecasting indicates a slowdown in a real estate sector, an investor delay investment in RFTs and instant add gold avoid loss. Last one is assignment in budgeting goal setting. Forecasting helps align investment strategy with personal financial goals like retirement, buying house, children education. Helps how to how much to invest monthly in SIP to meet a further goal. Example of assessment in budgeting and goal setting. An investor use Excel of to forecast further NAV of mutual funds. If NAV is an expected to grow at 10% annually and the goal is 20 lakh in 10 years, the SIP is calculated using the forecasting. Example, prediction next quarter stock purchasing price using historical forecasting, step by step forecasting using Excel or Python. Collect historical closing price at least 3 years. Use moving average or linear recognizing model. Identify the trend line. Forecasting the next 3 months expected price range. Forecast price is 2,800. Predictive price is after 3 months 3,100. Growth rate 10.7%. Decision investor decide to buy now and hold for 3 months or predictive growth. For in short, portfolio planning, how it works: set allocation based on return and prediction, guide in buying and selling decision, It works time the market entry and exit and see the market condition, budgeting and goal setting, align return plan 20 lakh retirement SIP based on forecasting. Next is time series and forecasting based. Time series data is data collected over time, daily, weekly, monthly. Time series forecasting involves analyzing pattern like trend, seasonality, noisy trends. Time series is sequence of data points collected, recorded at regular time interval, such as daily, weekly, monthly, quarterly, or annually. In finance, time services data typically includes stock price, interest rate, inflation rate, NV of mutual fund, exchange rate, sell revenue over time. Keep the time series data tracks how sometimes changes over times, not just across the category. Time series forecasting is the process of using historical data to predict further value based on patterns observing in past. It's widely used in finance or predicting stocks prices, forecasting mutual fund NVs, budgeting plan, cash flow projection, sales and revenue plan. Next one is moving average. Moving average is an statistical tool used in time services forecasting to smooth out short-term fluctuation and high return long-term trends or cycle in data. Think of this like trend filter that removes noise from the data so you can see the real direction things are going in. Smooth and out short-term fluctuation to show the overall trend. Use of moving average in finance. Identifying upwards and downward trends in assets pricing, stocks, NVs, and commodity. Filter out daily price noise. Confirm trend revenue. Make decision of buying and selling based on price crossing a market line. Predict further price movement using historical data. And types of moving average. First one is simple moving average, means SMA. SMA is an average of last n data point. Example, days, weeks, months, updated each period. Next one, using in forecasting helps is see whether the price is trending or down. Second one is trend line. Sorry, example of moving average. I'm giving example of moving average. Investor Priya is watching in a 50 days SMA on Reliance Industry. If a current price above the 50 days stock price is she consider buying. If the price drop below the SMA, she waits or sells using SMA helps her avoid emotional trade and focus on trend based on decision. Trend line and seasonality. First, trend line. Trend line is a straight or curved line that represents the overall direction of the data set. Over time, it helps to visualize whether the data is moving upward in positive trend or downward in negative trend to staying relevant flat on a trend. Purpose of investment analysis in trend line. In financial forecasting, the trend line are used to understand long-term movement in stock prices, index level, sales, revenue, or anytime scenario, financial data in an Excel. How to add trend line? uh, First, select a term time service chart. Example, in stock pricing over time. Click on the data series in the chart. Right click and choose the add trend line. Excel offer different types. Linear, straight line trend. Second one, pineapple used for more complex pattern. You can also choose discipline for equation on a chart. Show the R square value to measure it fit. For example, suppose you analyze the stock price of Infosys over the last 12 months. Adding a linear trend line helps you to identifying if the overall direction is upward indicates potential growth or downward indicates decline growth. Second one is seasonality. Repeats pattern at regular interval. Example, gold price may rise during the festival season. Uh, Seasonality refers and predictable pattern or inflation that repeat a regular interval such as daily, monthly, quarterly, or yearly. It's a key factor in time series forecasting. The seasonality is important. To recognizing seasonality helps to forecasting more accurately by and digniting between long-term trend and short-term recognizing fluctuation. For example, in five for example, let's just take gold price in India. Gold demand typically increase during the festival season like Diwali, Akshay Tritiya. This leads to a seasonal rise in gold prices every year during this month. An investor tracks gold prices while seeing a repeating spice pattern during the October November festival. How to identify the seasonality in the Excel? Collect the time based data, monthly gold price for 5 years, plot a line graph, look for regular peak and truths over time. Use moving average or decomposition techniques to spirit seasonality for trend. Key next forecasting tool in Excel. Forecast sheet building, moving average tool, data table, solver for optimization, recognizing tool in data analysis. First tool, forecasting, build in a tool. What it does, automatically create a further projection based on historical time series data. Example, sales stock price. How it helps? Plot further trends, show confident interval, possible range, and prediction. Uh, Forecasting sheet building in a automatically predict further time data through the essential ETS. How to go to data tab, forecast sheet, input data column and value column, use and causes, prediction, stock prices, forecasting quarterly revenue, projection, sales or demand, and visual chart line or bar, generate interactive line or column chart with and prediction. Second one is moving average tool. Moving average tool is means smoothing out short-term inflation to reveal the underlying trend in data series. How to use? Go to data tab, data analysis, moving average, select input range and interval. Example of 3 periods or 7 period moving average. Output shows smoothed value. Causes, understanding the trend in stock price, analyzing historical velocity, smoothing seasonal pattern in sales. We new column with average value helps dedicating direction or trends. Tip, add a moving average line to a stock chart or a trend analysis. Used to sensitive analysis show how changes is on to input affects the outcome of formula. To use variable or two variable data via formula, step formula. Example, return on investment or NPV. Use create a table showing how the profit with the price and changes. Visual, easy to read and matrix. Solver optimization. Find an optimal solution for a target value based on or turn creation. Used for profit portfolio optimization, finding idle pricing, where to find it under the solver, unable to add is not usual. Causes optimize assets, allocations, portfolios, portfolio with and contract budgeting risk. Solver, Excel builds in AI for finance decision. Summary table. Summary table, forecasting tool, main use and for forecasting sheet, further trend prediction, best for sales stock forecasting, moving average, smoothing volatility and data, stock price and stock prices and temperature demand curve, data table, simulation and pricing, ROI sensitive, solver, optimizing and portfolio design budgeting, recognizing tool, predicting model, risk return analysis and financial planning. Next one is ARM, auto recognition indicator, moving average. ARM ARM is A stands for A and R stands for auto recognition. I stands for integrated. M and A stands for moving average, which means auto recognition integrated moving average used for advanced forecasting of time, series, and data. AR auto recognition used to past value. I integration makes data stationary. MA moving average used past forecasting errors. It is an forecasting techniques used for one variability time services data, which means it's an predicated further value based on solvency on the past behavior of a single variable like stocks, price, inflation, GDP, etc. ARMS is an especially powerful when the data shows pattern over time but does not have clearly seasonality and handles with an similarity. Prediction analysis overview. Next one is predictive analysis of overcomes. Predictive analysis use data, statistics, and AI to predict what will happen next. Use of historical data, statistical model, machine learning, and AI data mining to predict further outcome based on past pattern. How it works, step by step, data collection, data cleaning and processing, further engineering, model forecasting. Uses of predictive analysis, forecasting investment return, predictive further price return or NVS of stocks, mutual funds, or portfolio. Example using historical returns is historical returns and microeconomy indicators that predicts next month return. Second one, prediction risk, anticipated portfolio velocity, default probability, or market downwards. Example, predict which borrowers are likely to default using credit history or financial ratio. Last one is customer behavior prediction, forecasting actions like buying or upgrading. Example, using past purchase pattern to recognize the personalized investment products. Business planning is an forecasting revenue demand or investor needs. Example, retail use it to plan stock level ahead of festival or sales. Tools for predictive analytics is used Excel, Python, Power BI, and AI model. Next one Recognize analyzing. In forecasting, recognize analyzing is a statistical technical used to examine the relationship between dependent variable means y, the one of you want to predict, or one or more independent variable x is an predict. The goal is to model how the changes in x affects y. It's widely based in finance, economic, marketing, and risk analysis. Recognizing analysis is an difference predictive variable based on one or more inputs of x. Example, prediction stock returns y based on GDP x. In Excel, use data analyze is greater than recognizing tool. Uh, Types of recognizing tool: similar recognition, multiple linear recognition, logistic recognizer. uh, Next slide is limitation of forecasting. Limitation of forecasting: uh, predict the news or event. It means that forecasting models are built using historical data. They learn patterns based on past behavior, but when sometimes unexpected happen like war or pandemic, these models can predict it. For example, suppose war, a sudden geopolitical conflict may causes market to crash, but a model would be but model would not know this was going. Pandemic pandemic situation like COVID-19 model trained on a past market behavior could not predict the massive market drop in early 2020. Company sandal: if a company CEO is arrested or fraud is exposed, the stock price might drop directly. No model based on the cleaning past data and predictive data. Why it's matter? Forecasting are only as good as data available. If the further brings something totally new, the model is blind to its. Second, based on past data which may not repeated. It means that most forecasting model assume that history repeated itself, that past pattern like growth rate, trends, seasonality will continue, but not always true. Example of that: change in the consumer behavior, a shift in a consumer performance. Example, moving from petrol to electric car may be past sales trend. Usually government policy changes, sudden changes in tax laws or interest rates can break past patterns. Technical distribution: a new technical technology like AI, blockchain might change the whole business environment. Why it matters? Forecasting may become invalid if the further behave a different from the fast, especially in the fast changing industry. Past data may not longer be relevant. Second one, third one, third one, result variant based on model accuracy. What is meant by result depend on model accuracy. Different model, linear recognizing ARM neural network gives a different result. If your model is poorly chosen or not trained well, the prediction will be an inaccurate. Factors that affect accuracy: factors: wrong model chosen, explanation: usually linear recognize when the data is an non-linear. Overfitting, model that fits training data not in predictability but fall on new data. Poor data quality, incomplete or incorrect data can mislead the model. Not testing the model on unseen data. Using historical data forecasting. First, I am going to tell us that historical data forecasting relies heavily on past data to predict patterns, identifying trends, and makes predictive about a future value. The quality and quantity of data used can make or break your forecasting model. First example, first at use at least 6 months or 5 years of data. Why it matters of using 6 months and 5 year data? Minimum 6 months allows the model to observe short-term, longer window 2 to 5 years helps to dedicate long-term trends, seasonal effects, and economic cycle. For the stock market forecasting, at least 3 to 5 years of daily or weekly data is ideally to understand velocity, bull bear phases, and micro trends. In sales forecasting, 12 to 24 months is often sufficient to capture monthly and seasonally variation. In for example, if you forecast car sales and you only look at least 2 months of data, your prediction may miss year ends discounts, festival season sales, annual price hikes. But using 3 to 5 years of monthly data will be show requiring seasonal patterns and sales trends more clearly. Second, and more data is equal to better trend dedication. It matters because the more data improves the model stability and accuracy, helps to dedicate trends. Example of trends: gradual growth or delay. Seasonality, example festival, holiday impacts, or any other. Cycle patterns, example boom, resizing cycle. Also reduce overfitting, the risk of the model performing well on training data but poorly on real data. Example of more data: if you if you are using Excel to build moving average model for forecasting gold price, a 30 days moving average using 3 years of daily price will be more reliable than even using just 60 days of data. Clean and prepare data before using. Uh, Raw data cannot often contain missing values, outer layer, example, extreme spikes in stock price due to one timeline events. Steps to cleaning data: remove nulls, format data, filter outlet, and standardize the units. Example, stock price, daily or weekly price used to forecasting returns or velocity. Sales data, monthly, quarterly sales used to demand and inventory planning. GDP, quarterly GDP used to forecasting market or sectors value. Interest rate used to predict inflation, borrowing cost, and stock values. Forecasting, why accuracy matters? The forecasting accuracy matters. A forecasting model in Excel, AI, or statistical tool helps to predict further value like stock price or sales. But after making prediction, how do we measure how accurate those predictions are? We use errors matrix to check the difference between actual value and predicted value. Then MA and means absolute errors. Two commonly used are either MA, means absolute errors, and means tells you on average. Means tell us you on average how much your forecasting was off in a simple unit like rupees or price or points. Next one is RS, root means square error. RSM tells you how much in is on average, but it gives more weightage to larger errors by squaring the difference. RMC gives more weightage to larger error. It's you how much bigger your bigger are mistakes. In simple language, acceptance MA and RMSC focus MAE focus on average absolute errors, RMSC focus on penalize larger errors more. Sensitivity MAE less sensitive to outlier, more sensitive. Use case generally forecasting RMSC AI model risk finance model. Easy to explain. MA is yes and RMS is slightly hard. Next one, accuracy metric AMSC. MAE, average of absolute forecasting errors. Easy to understand. RMSC, root square Root means square errors, penalize and larger errors. Next slide is backtesting forecasting model. Backtesting is a process of testing your forecasting or trending model on historical past data to see how will it would have worked. In simple language, think of this is an rely your for your model. If it is and perform well on old data, it may perform well in future data. uh, Backtesting forecasting or trending model on historical past data to see how will be it will have worked. On that we can do a future planning. How backtest data works. Backtest data. Imagine you build a model to forecasting stock price using historical data like moving average and ARMA. Collect historical data, daily stock price from 2018 to 2014. Split the data, training data. First, 80% of the data, example 2018 to 2022, used to train the model. Measure the accuracy using metrics like MAE, RMSC. Why is that analysis in Excel? What analyzing Excel to Power? The further in Excel that lets you see the impact of changing input values like inflation, interest rate, or return percentage on the final result outcomes. Exam. What is an Excel? Excel is what is what if in Excel. What if analyzing a powerful feature in Excel that lets you see the impact of changing input value like inflation, input changes your actual model. It helps answer that what happen if types of question useful for planning, forecasting, and risk analysis. In the investment scenario, you invested 10 lakh in mutual fund and what to know how different inflation rates will affect your real return. Scenario of forecasting templates. There are three scenario: best case scenario, worst, and best. Uh, there are parts of scenario analyze, a technique used in financial forecasting to assess different possible outcomes based on assumption about key variable, example return rate, inflation, market trend. Scenario types, what is and represent. Best scenario, most optimizing outcome means high return. Worst scenario, most pessimistic outcome means market crash. And best case, mostly likely relevant and outcome normally conducted. Example, let's us see. You have invested 1 lakh rupees in mutual fund for 5 years and you want to estimate your future value under the different scenario. In best scenario, there is 15%. In base scenario, 10%. In worst scenario, 5%. Then value will be 20,000. Value will be like in base scenario 16 lakh 10,510 and worst scenario 7 lakh 74,275. Forecasting dashboard in Excel. Combine charts, straight lines, forecasting sheets includes current performance, predicting value, risk indicators, filter for different years assets. Example, forecasting mutual fund, Mr. Investor profile. Name Ravi, age 35, profession, goal, plan investment for children education in 5 years, investment 5 lakhs in equity mutual funds. Next, problem of Ravi. Ravi want to know how much his mutual fund might grow in 5 years and whether he needed to invest more monthly. Forecasting process using Excel, collecting of NAV data from the last 24 months of his mutual fund. using Excel forecasting tool, forecasting using Excel forecasting sheet and predictive NEV for next 12 months tool data forecasting sheet, added trend line to visualize growth, calculated expected further value using moving average explanation smoothing to smooth the data. Forecasting result of forecasting predictive NVV after 1 year is 102 from current 91. Expected annual return is 12%. Estimated value after 5 years is 8.8 lakh if he invested 10,000 month. Tool used Excel feature forecasting sheet moving average data table purpose predictive NVV trends identifying growth patterns simulated SIP scenario. Next, role of AI in risk analysis and forecasting. AI in finance, artificial intelligence refers to development of computer system that can simulate the human intelligence such as learning, reasoning, and decision making in and context of finance and investment. AI use data-driven techniques to help investor to analyze and institution to automated, predicted, and excel financial strategy. Uh, AI helps to automate trade risk prediction, price, and dedicated fraud. Example, AI predicted further stock trends by analyzing thousands of data points in a second. Visual idea icons of robots, stock charts, and bank icon. AI does in finance. And what does AI do in finance? Analyzing data and identifying pattern, automation trend, risk analysis, price forecasting, fraud detection. Fraud detection. First, analyzing data and identifying pattern. AI can process huge volume of financial data. Example, stock price, economic indicator, company reports at inscribable speed to uncover patterns that are not visible to human eyes. AI learns from historical trends, correlation, and market signal, continuously improve its model by retraining with new data. After training, AI powers automatic trading where the machines are expected benefits and faster learning. Risk analysis quantify risks using portfolio and statistic, monitoring market volatility and single when portfolio risk exceeds safe level, adjusting allocation in real time. Price forecasting, AI predicate further price by analyzing historical price patterns, includes the external data like sentiment, microeconomic trends using machine learning model such as linear recognition, decision tree, nuclear network. In fraud detection, AI models are trained to detect pattern in transaction, unreliable behavior, example, multiple logins, unaccepted payments, used and heavily in banking, credit card, systematic and online trade of platform. Example of AI predicate stock market trends, analyzing millions of data points for stock earning reports and interest and even Twitter sentiments. The AI dedicates that rising oil prices plus weakness dollars have an historical lead to higher price in energy sector stocks. Based on that, the system suggests buying Reliance Energy shares before an upward trends. There are three types of AI used: machine learning AI, Deep learning, natural language learning process. First one, machine learning. Machine learning is a subset of AI where computer learns from historical data and makes predictive or decision without beginning explanatory proceed from its task. Application in common common of machine learning, linear recognition, logistic recognition, decision tree, and random forecasting, key nearest neighbors supporting. And the example of machine learning AI model predicts that the stock has 75% changes of gain value over the next month based on 3 years historical prices, market volumes and microeconomics indicator. Deep learning DL, complex nuclear network used for image or pattern recognizing. Deep learning is a more complex branch of MLA that uses a nuclear network with and many layers. It minimizes and human brain wise to the learning, and it is great at handling large unstructured data. Next one is LPR, natural language processing, understanding the text, example, newspaper, and twist. Deep learning model process the 5 years of stock tick data, millions of rows to predicate intraday trading signal with an accuracy. Accepts and definition data types and complex in simple language. The machine learning, deep learning, natural language learning, NLP definition. Machine learning from the data using algorithm. Deep learning, subsets of machine learning using a multiple layers nuclear network. AI field focused on understanding human language, data type, structure and unstructured data. In deep learning, mostly unstructured complex data like images, speech, and in natural language process, text in speech and data, complexity, sorry, complexity, less complex model. Example, decision tree, SVM, deep learning DL, very complex nuclear network model. Natural language process use ML and DL techniques to process language. Common use cases: predictive classification, image speech, recognizing complex patterns, recognizing chatbot, translator, voice association. AI risk management handles in big data, learn from market pattern, reduce human errors. Using AI in market, in research management, handling big data, learning from market pattern, use real-time alters, reduce human errors. Machine learning for prediction. Machine learning finds pattern in historical data and uses terms and predictive future outcome. Example, input, past stock prices, interest rates. Output, predicting stock price from next month. AI tools of AI, ChatGPT, Python, TensorFlow, Excel adds in. ChatGPT NLP based model for analyzing and summarizing. Python widely used for building AI and model. TensorFlow deep learning framework for nuclear network. Excel adds integrated AI into a spreadsheet. AI dashboard, monthly return forecasting versus actual. Description: tools, Python based, integrate with an Excel dashboard. Data: AI predicate return versus actual monthly return from May to Jan. Application: NLTP model used news based on NIP model used the news based on sentiments and forecasting result helps to rebalance portfolio in real time and improve forecasting accuracy. AI dashboard, monthly returns forecasting versus actual return. This dashboard compare AI predictive monthly returns with actual observing returns from January to May, helping accessing forecasting accuracy and adjusting strategies accordingly to tools used for AI dashboard is Python based on AI model integrated with an Excel dashboard. Python handles data processing, model prediction, and visual logics. Excel is used for visual output, comparing charts and real-time integration. Data inputs, historical market data, news sentiments, and microeconomics indicators. Output will be get forecasting versus actual monthly return from January to May. Sources: AI engines on past return using time service data. Application: NLP model, natural language processing, scrape and analyze the financial news and sentiments from headlines, convert is textual insights into a quantified sentiments. Courses: LSTM, long short term memory, nuclear network, time series forecasting model, capture historical trends and patterns to predict further return, especially substitute for and circulating finance data. Result out helps rebalancing portfolio in real time and improve forecasting accuracy by comparing predictive to actual each month, adjusting model permanence and strategy based on performance gap, adds in and productive investment decision, buying, selling, and holding. Predictive modeling with AI using input variables to predict a target outcome. Example: interest rate, inflation, earning, output, further stock performance. Excel plus Python can use to build a model. What is a predictive model? Predictive model is a technique used in data analytics and AI where historical data and variable coding to predict further outcomes. It is widely used in finance, marketing, healthcare, and operation. How it works: concept in predictive output. Example: interest rate affects borrowing and investment. Inflation affects purchasing power and cost. Company earning indicates portfolio and performance. Output: further the stock performance will the stock go up or down. AI in fraud detection. AI learns normal and abnormal behavior. Example, flagging a 50,000 transaction at 2 p.m. from a different city. Use AI bank NFC payments apps. AI portfolio. AI helps test portfolio using risk assets correlation. AI versus traditional forecasting. AI traditional data size is limited. AI based data size is larger. Uh, traditionally slow. AI based is high. Accuracy traditional is moderate. AI based is high. Speed traditionally slow. AI based is real time. Example, mutual fund house use at AI, select a best stock existed and decline an asset earlierly, adjusting portfolio faster. Example, quant mutual fund uses AI strategy in India.